This episode of MoneyWeek Talks is brought to you by Lion Trust. Lion Trust is an investment manager that believes in the power of being actively different.
So you can lead a horse to water, but it's quite hard to make it drink, even if you ask it nicely.
Savers put 4.2 billion into cash ISAs, 5.5 billion into easy access accounts, paying interest, and 0.3 billion into fixed rates accounts. So that actually says a lot that there is so much love for cash. So this is genuinely going to upset a lot of people.
The horse very much not drinking, having been led to water.
Absolutely not. Hello, I'm Kalpana Fitzpatrick. Welcome to this special episode for the autumn budget, which took place on 26 November 2025. Like all budgets, there are clear winners and losers. But it's fair to say there were way more losers in this budget than winners. Now, this was never going to be an easy budget for anyone to digest, and certainly one where the Chancellor Rachel Reeves has been subject to scrutiny. But most earners and savers are going to lose out. Everything from the mansion tax, the savings tax, the frozen personal allowance thresholds, a cap on salary sacrifice, pensions, and the reduced cash ISA allowance. It feels like a budget of take with little to give. I'm here with MoneyWeek's magazine editor Andrew Van Sickle and Cris Heaton, MoneyWeek's contributing editor, to discuss what the autumn budget means for you. Hello, Andrew.
Hi,
and hello, Cris. Great to be here in the studio together. I wanted to kickstart this discussion with the cash ISA cut. As of the tax year 2027-28, anyone under the age of 65 can only put 12,000 into a cash ISA. If you want to make use of the 20,000 allowance, you have to invest the rest. That's 8,000. So the reasoning behind this is it encourages people to invest and support British companies, i.e. we're heading for growth, supposedly. I think it's important for people to understand how to invest and how they can build long-term wealth. But has Rachel Reeves gone about this the right way? If we start with you, Andrew.
Well, we heard a lot from Rachel Reeves and the government generally, didn't we, about how important it is to encourage investment, which is completely and utterly true. The younger you start, the better. We all know about the magic of compounding and how important it is to invest in equities. The trouble is, of course, that hoping people will invest is not quite the same as ensuring they do. And when you look carefully at this and other measures of the budget, you get the impression that, the right hand doesn't quite know what the left hand's doing. We have here a situation where the idea is to have people not put too many of their savings in cash. I think the last time I checked, it was something like 2/3 of all ISAs actually just cash, aren't they? Something along those lines. And the idea is to make people invest a bit more. But then on the other hand, later on in the budget, we heard that she was going to put up a tax on dividends. She was going to make it harder to do the salary sacrifice. And this all kind of works the other way. So it's not entirely clear, how this will help. The other problem is that simply cutting a cash ISA allowance doesn't really mean that people will immediately go out and invest, particularly if they're nervous about the environment, which is something we'll talk about later, because it doesn't look as though much growth will be happening either from this budget. So I think this is, you can see the good intentions, but you wonder whether she's going to get there, A, and B, to what extent other measures appear to be working against it. You can lead a horse to water, but it's quite hard to make it drink, even if you ask it nicely.
And actually, I think it's going to be a bit of a bumper year for cash ISAs because just as we were coming into the studio this morning, I saw that the Bank of England released some data. Deposits in banks and building societies rose by 6.8 billion. Savers put 4.2 billion into cash ISAs, 5.5 billion into easy access accounts, paying interest, and 0.3 billion into fixed rates accounts. So that actually says a lot that there is so much love for cash. So this is genuinely going to upset a lot of people.
The horse very much not drinking, having been led to water.
Absolutely not. Exactly that. So if people are feeling nervous about the stock market, Cris, and they enjoy the safety of cash, they can still make use of that 8,000 allowance by making use of money market funds and bonds as well. Can you tell us a bit more about that?
Well, I think this is why I think this is such a daft decision in the first place. If you go back to the origins of ISAs, we started off with 3 products: the insurance ISA, which was the smallest and the one that nobody cared about, the cash ISA, and the stocks and shares ISA. And you could transfer from a cash ISA to a stocks and shares ISA, but not the other way. You had these sort of separate silos. And then we underwent a sort of wonderful process of simplification where the limit was raised, they were standardized. But there were still these fiddly little things like you weren't supposed to hold cash within a stocks and shares ISA for the long term. It was supposed to be just resting between investments. And then we had obviously the Help to Buy ISA come in, the LISA, the Innovative Finance ISA, all of which added complexity to what should be a very simple product. And rather than going down that route of making a single simple product, we've ended up with something where we're now introducing more complications, more differences between the product. There'll be restrictions on transferring between a stocks and shares ISA back to a cash ISA in order to prevent people just using that as a way of putting into a cash ISA. So there's no benefit to this at all, as far as I'm concerned. It's a totally counterproductive decision, and I don't understand why the Chancellor is pursuing it. I don't think it will have the effect of boosting investment to the stock market. As you say, at the moment, what you can do within a stocks and shares ISA is to buy a money market fund which basically holds very short-term debt. We're talking very, very short-term here. Typically, some of it's overnight lending, essentially, some of it's very short-term bonds. But you're talking about stuff that will mature within... It varies, but a month, 2 months, that kind of thing.
Will make people feel the safety of cash.
Exactly.
It will make them feel that.
But it is important to point out that these are not covered by the Financial Services Compensation Scheme, so it is not actually a cash deposit. It may be unlikely that you suffer a default and unlikely you suffer a loss, but it is possible. Now, what you have to worry about here is that if people become aware that, yes, you can do this as a way of holding cash within a stocks and shares ISA and getting a cash-like return, is that we will have restrictions on holding those within stocks and shares ISAs, which, of course, is what happened prior to ISA simplification when you couldn't hold very short-term bond funds, sterling funds, in the way that you can now. So if people want to take advantage of that at the moment, they can. But frankly, in the meantime, I worry that this is going to lead to, if people start doing this in bulk as a way to hold cash within an investment product, we're going to start to see restrictions on that brought in again, which is completely the opposite of what we want to see. So I give this a massive, massive thumbs down. I think it's one of the most counterproductive measures I've seen in a long time.
And the problem is it broaches this overall pattern we've seen in recent years, and particularly I think in the last year or so, where a measure's brought in and it sounds like a reasonable idea, but actually it's a fiddly mess. And then people will not behave in the way that they quite think because they got the incentives wrong, and then they'll have to tweak whatever it was that they did. And this kind of explains why there were 88 measures in this budget, 88. And until about 2010, 2011, there were about 15 or 20. And, we've spent weeks basically listening to the entire budget. So the overall pattern of complication and then realizing that they have to undo something is, very much still with us. And I think that that's a shame as well, because certainly with ISAs, people look at these things and they think, what should be a really helpful, simple way to get people investing and saving is now becoming even more complicated, and people just switch off after a while, don't they? I switched off 2 weeks before the budget, and I'm supposed to know all about it. You know what I mean? It's like, I can't be bothered.
There's certainly a lack of incentive here, which does make me think, was the British ISA idea as bad as we all thought it was initially?
Yes, it was another terrible idea. People should not, in fact, in practice within ISA, the data is so rubbish that you can't really tell very well. If you look at the actual ONS statistics on this, it's been compiled in really confusing categories. But if you speak to the platforms and get data across them, people already are overweight in UK equities within their ISAs. It's probably something like 20 to 30% weighting on average, whereas the UK market is about 5% of global stock markets. So there's no argument to say that people are underweight Britain within their ISAs.
Just a very quick one on that. Some people will approach it the other way around and say, well, if you've got ISAs and people tend to go for global stocks, then with the ISA system, the tax-free allowance, as it were, is subsidizing American stocks rather than British stocks. But you're right about the fact that the default representation is quite high anyway. I think actually on that subject, what is fascinating about the stock market and how it might get going eventually is that in 2000 there was this regulatory change which encouraged pension funds not to invest in the British stock market and to go for gilts instead. And I think if you unpick that, lots of countries like Australia, for example, pretty much most countries will insist that insurance funds and pension funds do a much higher default investment in their home market. That's how you could maybe get stuff going. I think that otherwise the British ISA for retail investors is a bit of a red herring there.
I think so. I mean, I think one thing we want to keep in mind here is that the reason you have tax breaks on personal pensions and on ISAs is you're trying to incentivize people to put aside money for their retirement or other savings purposes. You're not trying to use it as a way of boosting your stock market. So people should take the tax breaks and they should invest in whatever way that's appropriate for them, which could be 100% in British stocks or it could be zero in British stocks, but that's a decision for them. Trying to twist retail investors' arms to invest in the UK stock market because the UK stock market is structurally unattractive for other reasons is a really poor way of approaching it. Make your market attractive again, and investors of all kinds will come to invest in it, not ones who just have to be forced to invest in it. Andrew's point about the change in pension funds, obviously, 2 decades ago, in the way that they moved away from stocks towards bonds, is also a structural issue related to regulation, and a very good one. And that in itself was a terrible outcome, and you don't fix that by trying to get British individual investors to go in even more than they already are into a market that has been harmed by a whole bunch of regulatory issues.
Oh, Chris, on that subject, you were saying the other day that there's this half-assed approach to IPOs and reducing stamp duty.
Yes,
it's a good example of how that if you explain that.
Yes, well, Kalpana, I think you were going to come onto this anyway, weren't you? But to take it briefly,
let's do it, yeah.
IPOs, the plan is now that there will be a stamp duty holiday on new IPOs on the UK on the London Stock Exchange for about 3 years, which again is another daft idea, because for somebody who wants to maximise the long-term value of their company, a 3-year holiday on stamp duty and then the expectation that actually activity will decline because people become less interested in trading it when they have higher trading costs is not really going to tip the balance. You're going to go, well, 3 years of tax breaks here and this hanging over my head for when everybody who transacts it still has to pay 0.5% stamp duty. That's really attractive, isn't it? I think I'll still go to New York. So I can't see this having any benefit. The argument would be, I don't know how all of us feel on this, that you should just abolish stamp duty anyway.
Yeah, absolutely. So this is a policy that definitely gets the thumbs down. It's not going to help investors. It's not going to help the stock market. Speaking of another policy that I suspect gets the thumbs down as well from all of us is the salary sacrifice pensions cap. So this hasn't gone down very well from 2029. Anyone using salary sacrifice arrangements for their pension savings, it will cost you more, as only 2,000 of your contributions will be shielded from national insurance payments. So say if you were on 40,000 a year and you pay 5%, you'll see no difference. But if you're earning 40,000 a year and you're paying 10% contribution, you're going to notice the higher costs. Personally, I think meddling with pensions is a real shame. Pensions is another area that is so complex. We see endless reports coming into our inboxes each day, every week, talking about people not saving enough. How can we encourage people to boost their pensions? That's now being jeopardised. I think there's a danger that people will stop contributions and worry about the higher costs. And obviously there's an impact on businesses as well, which could have an impact on whether they hire people or other benefits that they offer as well. Just interested in what your take is on the cap on salary sacrifice.
Yes, it's a shame really, because as you say, pensions are something that people should really be dealing with, and the more faff and complication arises, the less inclined they will be to do it. And given this measure, they'll be less inclined to put money aside in a pension, which again undermines the investment point from the stocks and shares ISA, the cash ISA reduction. So it is a shame that this kind of fiddling. Also, another thing interesting about that is, as you say, it's a burden for employers, really, isn't it? Because then they've got more money for them to put aside, and then that kind of undermines the idea that now we are trying to be nicer to employers, having whacked them with a really high employers' NI contribution increase last year. So again, we're sort of right hand not really knowing what the left hand's doing. But I think, it's essentially, I know some people who have been worried for ages that the government's going to faff more and more with pensions to the extent that they just have ISAs because it's so much simpler. And now, look what Chris was saying earlier, now ISAs aren't even that simple, and now pensions are going to get even more complicated. And the overall effect, I think you're bang on, is to deter people from doing something that they really, really, really should be doing. So yeah, not exactly a thumbs up from me.
No, and it's a cost on the state in the future, isn't it, as well? Because we're going to have more people falling into the pension and poverty trap. We know the state pension isn't enough, and we do need people to save into a personal pension, but it genuinely does give the wrong message. It doesn't say we want people to save into a pension, please do it. It's, and I guess the other thing as well is pumping more money into your pension is a great way to, a smart way, should I say, to avoid falling into higher tax traps as well. Chris, can you talk about the £100,000 tax trap?
I think before we get onto that, just on the salary sacrifice thing, I think because it links into this exact point. If you have employers who are dealing, whose employee base tends to be better paid, who are more likely to make use of salary sacrifice, who are particularly aware of these issues. One obvious outcome here is that probably employers will stop offering such big salary increases, and it will instead increase their pension contributions, the employer pension contribution component, because that part will still be governed by the old rules. So I think the way that will interact in general could encourage increased employer or increased pension provision in some companies, but probably only at the companies that are already most attuned to this and already most concerned about maximising the value of this. So again,
for smaller companies, like the average company, I don't see them wanting the faff.
So your net outcome on this, I think, may be that it'll hurt probably people who are least in a position to think about this and adapt accordingly. So again, it seems totally counterproductive. And the 100,000 issue is exactly this, because we've ended up with this absolutely terrible system where when you go over 100,000, it becomes, well, it's a marginal tax rate of 60% anyway because of the progressive withdrawal of the personal allowance. But also, Kalpana, you are much better on this aspect of it than I am. In terms of certain other benefits as well, it interacts with them to have withdrawals. So you can end up being very badly treated at this point. And the salary sacrifice was a good way of keeping your income for those purposes below 100,000 and avoiding falling into that trap for some people. And there were a lot of people who were in that position. And now that flexibility is going to go away. Maybe the Chancellor is very happy with that in the short term as a way of getting a tiny bit more tax. But what it says in terms of consistency, in terms of equity, incentives, seems really bad. If you're going to do this, and I think it's a bad policy anyway, at least sort out the £100,000 tax trap and remove that cliff edge there so that you don't effectively spit in people's faces by saying, I've heard what you're saying about the problem this causes. I don't care. I'm just going to remove your mitigation.
In fairness, in the last few years, everyone's been saying to also the previous government, look, won't you fix the 100,000 cliff edge? Largely because a combination of inadvertent incentives have created this really unpleasant mess, and they couldn't be bothered. And here, if anything, it gets worse, right? Or it gets harder to manoeuvre around.
Yeah, essentially it means people pay a 60% tax rate, and I've heard so many comments like this whole weekend, people just like, well, what's the point of my pay rise? I don't really want to earn more, and I haven't got enough to see a financial planner, etc. So I feel like people feel like they've been left in limbo. So I absolutely agree. This cliff edge is kind of damaging for workers who just feel like I work hard, but what's the point? And
this is the picture of the budget, really, though, isn't it? It's not a budget that is. For all the talk about being growth, there's nothing pro-growth in this budget. There's nothing pro-investment in this budget. There's nothing in favour of somebody who's in that position saying, perhaps everybody does need to contribute more tax overall. Maybe that's required to sort out public finances, but let's make it evenly distributed. You're not getting that sense. You're just going, okay, we're content to leave these distortions in the system and just pick away. The expression that was used with this is it's a smorgasbord of tax changes. It doesn't feel like a smorgasbord. It's like you've got a cheese board with the pairings left behind after the rest of the cheese has been taken.
And funny enough, there is scope. If you go further down the tax spectrum, as it were, I think the median worker pays less compared to higher earners than in quite a few other countries. So you could totally make a case for, for sheer consistency, whack a couple of p on income tax perhaps, and not this endless fiddle where it's like, let's see if we can get a bit more from here, and then create all these distortions and incentives. So I think Chris is bang on. This is not something for growth because people are not given the right incentives. Many governments go wrong by not really thinking through how people are going to approach something. It seems like this is definitely one of those. More broadly on the macro, we've now had about 26 billion in tax rises, and then the last time round it was 40. As far as I can tell, I had a quick look at the figures, that's like the biggest consecutive tax rises in 2 years for a couple of decades now. I mean, this is a lot of tax. So, generally, if you increase taxes, activity will slow somewhat. So that's one problem. We have a spending, a government that really enjoys spending, it looks like, and there's certainly not even the remotest attempt.
But spending rather than investing.
Exactly.
I think this is the important point.
Yeah. We're not doing so much capital investing, we're just doing lots of little things for backbenchers, really. So overall, we have, the day-to-day spending problem as well, so crowding out investment as well. And then on the productivity stuff, the stuff that Labour was supposed to be all about, do you remember in 2024, it's like, we can fix the planning. Turns out they can't fix the planning. Okay, so you've got this environmental there's a system now to make sure that things like bat tunnels don't interfere too much, but that's been watered down, sounds like. So they haven't got that either. So what are we actually left with in terms of fixing everything? Already KPMG said this morning growth will probably be 1% next year, not 1.5%. Right now the OBR is thinking 1.5%. The whole idea of the government, the whole shtick really was to we can do a step change in growth. We should be okay. And in the end, the best way to help people is not like these little subsidies and these fiddles. Grow the pie by growth. Yeah, and I can't see any sign that that's going to happen at all. So we're really stuck here. We have the unbelievably complicated tax system. We have no growth. The spending is on stuff that isn't really long-term investment. It doesn't really add up to anything terribly encouraging, does it? So buy baked beans and gold.
But this actually brings up an interesting question, because obviously we've had the various tax increases, the extra 2p or 2p in the pound on savings rates. We've had the increase to dividend taxation for basic rate and higher rate taxpayers. It's all fiddling around the edges. I think both of us, or all of us, could sort of put this question out. Would it be better just to raise income tax, merge income tax with the NI, broaden the tax base in that place, simplify the tax code, rather than doing this? Would we give this a thumbs up or a thumbs down if Rachel Reeves had come out and said, income tax is going up, NI merger, which is more complex than it sounds because
it is. Nigel Lawson was talking about this 30
yes.
years ago, to be fair. I mean, this is not the simplest thing, but he always said, one, you should stand up, as a chancellor, you should stand up every year and scrap a tax as well as introduce a couple of things. And we really do need to get back to that, because everything is now such a sprawling mess that I think you're right. If you did a simplification, also for investment, people look at the UK and they think, God, what's all this faffing around? If she'd come out and said something along the lines of, actually, it's time to really sweep this mess up. I think, to be fair, various chancellors of the previous government should really have started to think about this also. Yeah. But it makes a better impression on international investors, doesn't it? Which comes back to the stock market being more attractive, etc. And then we have a virtuous circle, maybe, not a vicious one.
Yeah, we haven't got a strong story to tell at the moment
not
when it
really,
comes to investing in the UK in any shape or form. And I absolutely agree. She's like, there's just too much fiddling, too much scraping around the sides, and nothing really meaningful. And it's upset far too many people.
Which change do you feel is worse? Because Andrew and I have raged about our bugbears. Which do you dislike the most?
Well, in terms of the ones, I think the pension ones I feel like is probably the one that I feel is quite damaging, just because I know someone who's written about pensions for way too long, but it's a message that I just think it gives out the wrong message. We want people to save into a pension. We want people to invest, and it's not telling me that. It's actually, I think there's a real danger that people would just stop. So I feel like, So
I think you're right. I think that's probably the nastiest one, because it's just the worst incentive, and it could be lasting damage. Yeah. No, not just like there's sort of fiddly stuff.
Exactly.
I don't like the VCT tax change as well. I think the pensions is a bigger issue, but taking a bit of history here, 20 years ago, the VCT tax relief rate was 20%. It was increased to 40%, and that sparked a huge amount of money going into VCT investments. And then it was cut to 30%, which had a bit of a bump in the short term, but it's grown pretty well since then. But in the last year, there's actually been some problem with VCT fundraising. The level has dropped off quite significantly, which you could put down to a whole bunch of reasons, including, I think, the general lack of optimism around. And now, obviously, VCT tax relief in the budget is being cut from 30% to 20%. Yes. And this seems like the very last thing you want to do if you want to encourage people to invest in growth and put money behind new businesses. Exactly, innovative businesses. So I think the salary sacrifice will rightly get a lot of the attention. But if you wanted to point to the thing where you said there's just no coherence here in terms of this is a pro-growth budget, what are we doing to encourage growth? Oh, we're cutting tax relief on early stage company investments. That's just complete left hand, right hand, not even in the same room.
Yeah. And also to remember there's a huge package of employment measures coming in, which apparently costs about 6 billion or 5 billion. So it's like on top of all this mess, now companies, small also I think, will have to deal with very complicated labour laws. And one of the things we had in our favour as a country is that it's not the structural unemployment isn't as high as on the continent because it's slightly easier to hire and fire people. If you make that more complicated, which they're doing, and that's another 5 billion on companies, also small ones, that makes it even less likely there's going to be growth.
Yeah. Absolutely.
And this also comes, it's the same package as the employer NI issue and the hike there. Nothing incentivizes people to add to the workforce and try and grow the business at the moment.
Yeah,
yes.
Absolutely. And there's another policy that when you ask me what's the worst measure, well, actually, I'd say also it's the frozen tax allowances. Yeah. I just don't think that's really helped. So I'd say that's probably one of the biggest hit.
Which she also said she wouldn't do quite explicitly, right? She did say, oh, no, I don't think we'll do any more freezing or no more fiscal drag.
Well, and it's 2031. Well, it is frozen. So it was due to end on 2028, but it's now been extended to 2031. It's a stealth tax and a squeeze on working people.
It is. Did you see the CPR calculation on X where they said that if you take the fiscal drag, they've been doing it since 2022, the idea of constantly extending the fiscal drag, it's now, if you take it across the whole time period, it's a tax rise of 67 billion.
Wow.
That's a lot, right? That really is something. It was interesting to see that figure crystallize because it's like, this is what it costs you just for inflation to nudge your salary up.
Yeah.
There is one counterpoint to this, which is one of the reasons why we have the narrower tax base than we might otherwise have compared to a lot of other countries, is because the personal allowance was increased so much at the start of the coalition government. Yeah. Before that, it was much lower. We bumped it up quite a bit. And it's been frozen for quite a while now, but that one-off lift did do quite a lot to change the tax base. So you could make a case that, okay, freezing that is gradually over time broadening the tax base and restoring another issue. But then you look at the detail of this one where you say, okay, there's a specific carve-out here where people whose only income is from the state pension are going to be exempt from paying income tax over it, even when inflation takes you over the frozen allowance. And this is just another completely inconsistent principle because you're saying, okay, implicitly, by freezing the allowance, using fiscal drag, we are broadening the tax base, but we don't care about applying it to pensioners. Yeah. And once again, working families
it's invidious, isn't it? Because you have this, you start to make this division, and that's become also the whole faff about the pensions is the private pensions, the DC ones, and the defined benefit ones, the cushy civil service pensions, are totally untouched by all this. And so again, it's like, of course, I know all governments have their clientele, right? Yeah. So of course, Labour's not going to mess too much with the public sector pensions, but you always think, we need to start addressing that slowly because,
Absolutely. So fiscal drag obviously is going to be another thing that most people are going to feel for years to come, I think. So she doesn't want you to put money into a pension. She doesn't want you to save too much in cash, and if you invest, you're still going to be hit by a higher tax rate. Another thing is, and also income from property gets taxed, is going to be subject to 2 percentage points.
So less incentive for landlords to do their thing, less space for rent,
Yeah.
more rent drama. It all goes on and on, doesn't it?
Yeah. So speaking of property, there's another tax that we haven't spoken about. We're talking about a lot of taxes. Mansion tax. I've dubbed it the mansion tax. Officially, it's called a council tax surcharge. So if you have a property that's valued at over 2 million, you're going to be subject to a new tax charge, 2,500 to 7,500. Now, there's a lot of people obviously bought properties years ago who aren't going to like this. I mean, no one's going to like more tax. But what impact do we expect on the property market in the years to come when this kicks in?
So in theory, you say, okay, this is going to affect the top end of the market. It might encourage people who are pricing at that level to price a little bit under to set the benchmark for
Chop
that.
a house into two with two flats.
Or that.
But
There's all sorts of weird incentives sometimes.
Yeah, exactly. I think it's quite hard to say, really, because there's also an argument that if you're buying a fairly expensive property, for most people, the difference is, or for many buyers, the difference is going to be quite small. Although if you happen to live in a property that you've owned for a long time, whose value has increased over time above that threshold, then maybe it does start to bite. You're talking about older person on a limited income. For all we were saying about tax on pensioners, it's important to bear in mind that there are many people around who are retired, who've got quite strained finances, who nonetheless might be living in a property that actually could be caught
You get
by
the
this.
asset-rich, cash-poor problem.
Exactly. So I think what I'd fundamentally say here is that, once again, this is a small change whose consequences are kind of unpredictable, but you go, how many ways can we say fiddly? I feel like we've used it a lot. Rather than having the boldness to say we need a more fundamental reform of council tax or local taxes or property taxes or land tax or whatever you want to talk about as the framework, once here's a little cheese paring tariff on a specific section of the market that we assume that people are not going to have much sympathy towards. And does it really achieve anything except, yet again, more complexity?
I think the problem is too with that is that it will tend, the property market often just doesn't move the way it should, and stamp duty is a problem. And it seems that anything you do to gum up the market, now I think this will probably mean that people near that threshold will be much less inclined to sell. Fewer people paying stamp duty because they don't want to do that either. I would just get rid of stamp duty because it's one of those friction taxes that really screws up productivity too. If you can't move easily to where a new job is, that is bad for the overall productivity picture. So I think if anything we have, as you say, a bit more complication. There will be amazing creative ways that people will get out of this, human ingenuity being what it is. It comes down to the general problem with wealth taxes is that they're much fiddlier really to implement than you think. That's why on the continent there were about 12 or 13 countries who had wealth taxes in the mid-90s, and now they're literally 3. It's actually much harder to get money out of the rich than you would think, but this will just mess up the property market. I think you're quite right.
Yeah, although I think the key point that you just made actually is people that are asset rich but cash poor, and they are going to be people that have bought their properties many years ago. It just happens to be valued at 2 million plus, but that tax is going to be quite a hit on them every year.
I think you're quite right.
Well,
about that.
in a similar spirit, this is like the changes to inheritance tax around business property relief and agricultural property relief, where you've ended up with a tax where in theory you're trying to tax people who have deliberately used investment in, for example, land as a way of avoiding inheritance tax. But in practice, the people who are going to be most affected are the ones who have built a business that, because of the inflation in land values caused by this, have gone up, but are not in the same position as people who've caused it, and are going to have the greatest difficulty dealing with this and keeping the business together and passing it down generationally, which seems, again, totally counterproductive, totally anti-growth, totally anti-working people. And the tiny concession offered on that in terms of the portability of the tax relief band between spouses is just... It'll benefit a few people, but there are many people whose affairs will be such that it won't help them at all. And it's just tinkering around the edges, not acknowledging that you made a fundamental mistake in how you set this tax originally and adjusting it properly.
Exactly. Make a mistake. New measure happens. New measure sounds okay, but it's a bit tokenistic, especially with, taxes being a cost of living. So you're not really getting the help with the cost of living. And then, as you say, new complication, new problem. And the cycle continues. In their next budget, it'll have to be addressed. And there'll be not 88 measures in the next budget, but 98.
Yeah, and there's been a few tokenistic measures, for example, freeze on prescription charges and energy bills being lowered.
Yeah.
So I feel, but they are, as you say, tokenistics, because actually we're all going to be paying a lot more in tax anyway.
Exactly.
So
the tax is the cost of living,
exactly,
as you quite rightly point out.
Exactly. I wanted to move a little bit onto the macro side of things and what impact this is going to have on the overall economy and the stock market.
Well, overall economy, we've kind of checked off, haven't we? That's
we haven't
basically 0 to 0.
Yeah,
I think to be
I just
fair,
wanted to emphasise
no,
that.
you're quite right. But to
Undermine animal spirits even more, I think. Does it encourage you to invest in the UK, to build a business, to plan for the future, to have any optimism, or does it further increase the brain drain in terms of businesses and people leaving the country? I feel it's the latter.
Yes.
I mean, to be fair,
said, let's try and find the positive.
Let's try and
I
find
know
the
it's a
positive.
Monday
What
morning,
positive
but
can you find?
so what we could actually quite reasonably tell listeners and investors is that the stock market is an interesting area because you do get great exposure to the global growth as well. About 75% of FTSE 100 companies' sales are from overseas. Down in the mid caps, it's about 50-50. So there's certainly no reason to not. You don't have to go and hide in a cave. Though. I think MoneyWeek has been telling people long enough to buy gold and baked beans. But it's not like you should stop investing. Just in difficult times where you really can't expect much oomph in the economy, then you go for your income. Go for your income funds. Make sure that you try and stay a bit ahead of inflation, because we still have what MoneyWeek likes to call the stagflation light scenario, I think, and inflation is going to be a wee bit higher than the bank's target for quite a long time, probably, given the more fractured global trading environment, and that leads to higher prices. So, you should certainly still invest. And the great thing is that investors in the UK stock market are being paid to wait for it to get its act together. There's a lot to be said for the compounding effect of, the yield is about 4%, is it, I think, on the... Yeah, so, there's really no reason not to invest at all. There's always a good reason to invest. And MoneyWeek explains exactly where there's fabulous growth and value beyond the UK, so you should do that too. But don't be despondent. Just be a bit cautious. That's all.
I think that's right. I think one of the points here is obviously we worry about the UK stock market in terms of its future, the hollowing out, companies going elsewhere, but at the moment, it is still heavily a global proxy, albeit you don't have exposure to some of the sectors that you might want. So you do need to be internationally diversified. But for all I said earlier, okay, maybe UK investors are overweight the UK in their portfolios. That can definitely be a rational decision if you're following certain strategies, because there are definitely companies in the UK that are globally exposed but offer dividends or offer a counterbalance in terms of sector exposure, or are simply attractive companies that probably eventually will actually decamp elsewhere and list somewhere else to get a higher valuation. But at the moment, you can buy them cheaper in the UK market. I think one point to add to that, of course, I think most investors have taken this on board now, but it's worth repeating if not. If we go back a decade or so, we used to say that if you're a basic rate taxpayer, your need to use an ISA for cash was in many ways greater than your need to use an ISA for investments, because you had, initially effectively no basic rate dividend tax, and then relatively low basic rate dividend tax and a fairly large dividend allowance initially when it was first introduced, and a decent sized capital gains tax allowance. And now the changes over the past decade have largely done away with all those opportunities, and even any basic rate taxpayer sooner or later is going to be drawn into the net on dividend tax and capital gains. So you
Much
have to make
faster
use of your ISA. Exactly. And that's the big change. I think people have woken up to this now. But if you not getting investments within your investment ISA at the moment, you should probably be doing so, because this is only going to get worse.
Yeah, absolutely.
And at least it's still there. The shelter is still there.
Yeah. I would say it's still important to be able to invest in the UK, as it is in other global stocks as well. And it's all about having a well diversified portfolio, but also it depends on your ultimate goals, etc. as well.
It does. And also, not least, you don't really want the currency faff, do you, constantly? If you've got, decent exposure to your home market, you're not constantly stressing about...
Well, this, of course, is another one. I'm going to take this hobby horse out for a gallop now. The change that I would have liked to see to ISAs was letting you hold foreign currency balances within your ISA so that you are not clobbered by brokers on currency exchange every time you trade in and out. Yeah. That's the thing that we have been calling for years. It's the big glaring flaw in the ISA
No,
arrangement.
we have. It's been. I remember it's in lots of your ed letters. It's been in some of mine. You know what I mean? That'd be a really genuinely helpful thing for people to do.
So when this supposed ISA, I'm not sure if they're calling it an ISA simplification, and it probably won't be simplification, but this sort of overview of ISAs that's coming up and what the framework should be in future. I mean, apart from the fact that I'd just like to abandon this new cash ISA restriction and just sweep everything into one single account, for Christ's sake, give us the ability to hold foreign currencies in an ISA. It's just ridiculous.
Yeah. I would like to have seen the ISA allowance just generally upped as well. It's been at £20,000 for some time now. So that would have been a better incentive.
Yeah, you're right. It's been stuck there for ages. I wonder what it would...
I
I haven't seen the stat recently, but what it would be if it had moved with inflation. Probably good 30 by now.
Yeah, it's just been at 20,000 for way too long.
Yeah.
And... so also she didn't say anything about junior ISAs, which I feel like if there was going to be a cut there, personally I would like to have seen a cut there because it's a bit of a trap. Imagine giving a child this large sum of money that they then don't know what to do with when they're 18, and there is this danger that they're actually going to spend it on something they probably shouldn't, and parents have no control because it's stuck in a junior ISA. So probably maybe more flexible rules around that as well.
And the LISAs are a mess as well, aren't they?
And that's up subject to reform, so that's going to change as well, but we don't know all the full details yet. So it's not simplification, it's something else. And so finally, obviously I think we've been very negative about this budget, rightly so. What would you say your very final tips to listeners are? I'm going to start with mine, is just look at investing. If you're just nervous, you don't know what to do, it is worth reading up about it. We have plenty of articles on MoneyWeek.com as well to help you get started, and I think that's really important to take those steps. Obviously make sure it is right for you. Don't stop pension contributions. And if you can, get financial advice, because some of these changes won't come in for a good few years. So now is the time to think about how you might deal with the tax increases, if you're getting a pay rise, what you might do with that, and your pension as well.
The first one, obviously, is make sure you're making the best possible use of your allowances for investment purposes. So, yes, your investment should be inside your ISA, and that's only going to become more and more important. Make use of salary sacrifice while you still can. The one uncertainty here is this measure is not supposed to come in until 2029, the cap on salary sacrifice.
So who knows?
It's very helpful in terms of making the projections look good at the moment. It may well never happen, but nonetheless, you should probably make use of it to the extent that you want to over the next few years. I think those are the two obvious takeaways from the budget. There are going to be impact on, say, VCT investors. You're going to have to reconsider. I mean, the tax tail should never wag the investment dog, but in practice, the tax relief there does provide quite a lot of compensation for the added risk.
Actually, I noticed there was no drama with AIM this time, right? So
no, that was all dealt with last time. Exactly. Drama each time. So I think in all these questions, yes, you end up saying post-tax changes, is this thing that I've been investing in for quite a while still as attractive as it used to be? I think this is the main thing coming out. I find it very hard to turn around and say, and you should invest in the UK on the basis of this, because it hasn't given us extra reasons to. But as Andrew kicked off by saying, there are opportunities in the UK market, and in a sense, the level of gloom and the impact of valuations...
pretty much in the price now.
Yes, it potentially creates even more ones. So I think there are things to go out there and look in the UK market and say, it's not necessarily affected the investment case for any of these things. You do, and we're looking further and further ahead here, you do start to think about things like, for example, renewable... This is a change, not directly tied to the budget, but around the same time, the potential changes to inflation linking on the renewables investment trusts. That kind of thing does make you go, okay, if I'm taking on certain UK investments, how much policy risk do I have around these things that are supposed to be simple and encourage investment? Which leads me back to one of my consistent arguments, which is investors should be globally diversified. Regardless of what the Chancellor would like to make you do in terms of investing in the UK, you are investing for your own future and for your own financial security. And if you don't trust policy making in the UK and you have concerns about that, you should be trying to spread your investment to minimise your exposure to policy risk anywhere.
MoneyWeek.com and MoneyWeek Magazine always explain exactly how you should do that. There are lots of good opportunities all over the place. There is always, however gloomy things seem at home, some growth and some value somewhere. as we were saying at the conference. So there's always something. Exactly. I mean, the big takeaway really is just don't worry too much. I mean, one can't expect miracles at a time when, the productivity has basically disappeared and growth has disappeared, but that's no reason not to invest. I would sort of skew towards income, given that inflation is probably a wee bit higher than you'd like it to be, and it's important to try and stay ahead of it. Also remember that dividends basically produce the lion's share of stock market returns over the long term, certainly in the UK. And always have gold for insurance. I think it's important to reiterate, isn't it? Probably about 10% of your portfolio. And, I know, Kalpana, you were saying that, the JISAs is often a bit of a problem because they're just so irresponsible. But I love to tell young people that's that story about the penny, that if you just double something every day for a month, you'll have 1 million. You just explain to them the power...
rice grain on the chessboard.
Exactly, the power of compounding is always going to be your friend, you know what I mean? And you don't have to worry about the government not being terribly good at what it does, or, there's still, even in the UK, you are exposed to the globe. So just stay positive and always keep investing.
Yeah,
and just have some baked beans as well under the bed.
Andrew, what's our motto? I forgot to say it earlier.
Make it, keep it, spend it.
Thank you.
Yeah, and don't blow it.
Don't blow it. You just added a new one there. Thank you very much.
We did used to have a blowing it page, didn't we?
We did, yes.
Let's not go into that now. Okay, another time.
Great. Well, thank you so much. Thank you, Chris. Thank you, Andrew.
Thank you.
Thank you.
Thanks, Kalpana.